In the last 30 days, something extremely important has happened in the financial system, and most people are looking at it as separate events. Gold fell almost 9%. Silver collapsed more than 26%. A massive private credit fund tied to one of the largest asset managers in the world lost nearly 19% of its value in just one quarter. At the same time, margin requirements were raised on futures exchanges, banks quietly increased risk controls, and the IMF issued warnings about hidden exposure inside the banking system. These are not isolated accidents. They are connected. They are symptoms of the same pressure building underneath the global financial structure. What you're watching right now is not just a correction in metals. It is a stress test of leverage, a stress test of liquidity, and a stress test of confidence. Most people think market crashes begin with fear. They do not. They begin with structure. Fear only arrives after the structure breaks. Silver did not collapse because investors suddenly decided silver was worthless. It collapsed because too many traders were positioned the same way, using too much leverage, inside a system that depends on stability. When that stability cracked, the selling became mechanical, not emotional. Open interest in silver futures had been rising for weeks. That meant more contracts, more leverage, and more exposure concentrated in one direction. At the same time, volatility started creeping higher. The moment volatility rises, exchanges automatically increase margin requirements. That is when the trap closes. When margin requirements rise, traders must choose between two options. Option 1, add more capital. Option 2, reduce positions. Most traders cannot add capital, so they sell. When they sell, prices drop. When prices drop, more margin calls appear, then more selling, then more forced liquidation. This is how a market falls vertically without any dramatic headline. On top of that, algorithmic trading systems and systematic funds began selling when key technical levels broke. These systems do not care about fundamentals. They follow rules. When price breaks, they exit. When volatility spikes, they de-risk. This adds speed and violence to every move. At the same time, options dealers were forced to hedge positions as silver fell through major strike prices. That hedging required selling futures into a falling market. This pressure is invisible to most investors, but it is very real. Here's a part of the story almost nobody is talking about. While the price of paper silver collapsed, physical silver didn't. Premiums in many regions held firm. Industrial demand didn't just vanish overnight. And guess what? Long-term holders weren't flooding the market with their physical supply. That tells you everything you need to know. This was a paper market event, a financial maneuver, not a collapse in the real-world value of the metal itself. And this is where the story gets so much bigger than just silver. Because silver isn't just a metal, it's a mirror reflecting the health of our entire financial system. The same stress, the same cracks you see appearing in the silver market are now showing up in a much larger, much murkier part of the economy: private credit. Now, what is private credit? Think of it as a shadow banking system. It's a multi-trillion-dollar market made up of loans created not by traditional banks, but by hedge funds, private equity firms, and massive asset managers. These loans are opaque. They're not transparent. They aren't reported publicly in the same way bank loans are. Yet they are deeply, intricately woven into the traditional banking system through complex derivatives and hidden funding chains. Here's how it works. Banks lend money to the funds. The funds then lend that money to companies, often ones that are too risky for the banks themselves. When those companies struggle to repay their loans, the losses don't just stay with the fund. They travel backward through the chain, right back to the banks that provided the initial funding. This is the exact pattern, the exact domino effect that has kicked off major credit crises in the past. It's not just me saying this. The International Monetary Fund, the IMF, has already issued warnings. They've pointed out that major banks have large, often unquantified, exposure to this private credit market through these indirect channels. That means when defaults start to rise, and they will, the damage will not stay contained. It will spread like a virus through the financial system. And we are already seeing the early tremors. Delinquencies on subprime auto loans are spiking. Several highly leveraged companies are finding it nearly impossible to refinance their debt in this new, higher interest rate environment. We just saw a major private credit fund lose nearly 20% of its value in a single quarter. Let me repeat that. 20% in just 3 months. That is not normal market fluctuation. That is a system under extreme stress. When stress appears in the credit markets, the entire system tightens up. Liquidity, the lifeblood of the economy, dries up. Lenders pull back. Risk is taken off the table. And the assets that depend most on leverage and easy money are the first to fall. Silver, being a highly sensitive, highly leveraged market, just happened to be one of the first visible cracks in the dam. Now, this is where the conversation gets a little uncomfortable, but we have to have it. A lot of people are asking the wrong question. They're asking, will the government confiscate gold and silver like they did back in 1933? That's thinking about today's problems with yesterday's mindset. It's the wrong framework. Confiscation today wouldn't look like soldiers knocking on your door to take your precious metals. It would be far more subtle, far more digital. It would look like regulation, taxation, and most importantly, control over conversion. Think about it. Back in 1933, the government needed physical gold to back the currency. The dollar was tied to gold. Today, our currency is purely digital fiat. The government doesn't need your metal. It needs control over the system where you can exchange that metal for usable currency. And this is where central bank digital currencies, or CBDCs, enter the picture. CBDCs are being actively developed right now by the Federal Reserve, the European Central Bank, the Bank of England, and many others around the world. They're being sold to the public as a way to have faster, safer, more efficient money. But the reality is far different. CBDCs are programmable money. Now, what does that mean? It means they allow for unprecedented levels of tracking, restrictions, automatic taxation, and even conditional spending. Your money could have an expiration date. It could be restricted from being spent on certain goods or services. In a world with CBDCs, you might still own your gold and silver, but the act of converting it into usable digital currency could be restricted, delayed, or taxed so heavily it becomes impractical. Any large gains you make could trigger automatic reporting directly to the tax authorities. The asset isn't physically taken from you, but its power, its utility, its very purpose as a store of independent wealth is systematically weakened. And it doesn't stop there. Add on top of this the growing discussion around state-level wealth taxes and exit taxes. Some states are already seriously debating taxes on unrealized gains. This is a crucial concept to understand. It means you could be forced to sell your assets, like stocks or precious metals, just to pay a tax bill on the value they've gained on paper, even if you never cash them in. You're taxed on wealth you haven't even realized yet. This isn't some far-off theory. Versions of this already exist in parts of Europe and in limited forms, right here in the United States. So you see the playbook. It's not about confiscation, it's about control. It's about creating a system where alternative assets outside the direct control of the central banking system, are difficult to use and expensive to own. The pressure to stay within the official digital system becomes immense. This is why understanding what happened to silver is so important. It wasn't just a random price drop. It was a signal. It was a warning shot from a financial system that is becoming increasingly fragile and centralized. The moves being made today, the development of CBDCs, the talk of wealth taxes, the increasing opacity of markets like private credit, are not isolated events. They are connected pieces of a much larger puzzle, a puzzle that is shaping the future of money and freedom. This isn't about fear. It's about awareness. It's about understanding the rules of the game as they are being rewritten. The cracks are appearing, and paying attention to them is the first and most critical step. Have you ever wondered about silver? It's not just a pretty metal for jewelry. It sits at a fascinating crossroads, influenced by three massive forces. First, there's industrial demand. Silver is in everything from solar panels to your smartphone. Second, there's financial speculation, traders betting on its price movements. And third, there's monetary fear, people buying it as a safe haven when they are worried about the economy. This unique combination makes silver incredibly volatile. It's like a canary in the coal mine for the entire financial system. When money gets tight and liquidity dries up, silver is often the first major asset to fall. But when confidence in the system shatters, silver can explode upwards with incredible force. This sensitivity is why, historically, silver has seen some of the most extreme price swings of any major asset. It's a wild ride. So when we see a massive drop in the price of silver, like we've seen recently, it's easy to panic. People immediately start asking, will it go back up tomorrow? But that's the wrong question. After a big sell-off, driven by forced liquidations, the real question we should be asking is, has the selling pressure been exhausted? Think about it this way. Markets don't need a flood of new buyers to start rising. They just need the sellers to stop selling. And when the downward pressure is gone, even a little bit of buying can push the price up. So how do we know if the selling is done? We need to look for specific signals, not get caught up in the emotional headlines. The key signals to watch are volume, volatility, and market behavior. We need to analyze the data. Are the moves to the downside getting smaller and losing their momentum? Are the rebounds, the bounces back up, becoming stronger and more stable? Is the open interest, the total number of outstanding contracts, falling while the price starts to level off? These are structural signals. They're based on the mechanics of the market, not the feelings of the crowd. They tell us what's really happening under the surface. And historically, when silver collapses because of forced selling, it doesn't just shoot straight back to the moon. That's not how it works. Instead, it usually enters a volatile consolidation phase. The price will swing up and down, testing everyone's confidence. It's a process that shakes out the weak hands, the people who bought with too much leverage or without real conviction. Only after this reset, when the market has been cleansed of weak holders, does silver become truly explosive again. Now, while this is happening with the metal itself, there's another layer of opportunity that opens up: mining stocks. This is where things can get really interesting. Mining stocks offer leverage to the price of the metal. Here's how it works. A mining company's costs, like labor and equipment, are relatively fixed, but their revenue is directly tied to the price of silver. So if the price of silver goes up by 10%, a well-run mining company's profits can jump by 30, 40, or even 50%. That's powerful leverage, but it's also a double-edged sword. Mining stocks are fragile. They carry their own set of risks. You have to consider the jurisdiction. Is the mine in a politically stable country? You have to look at their debt. Are they financially sound? And you have to evaluate the management team. Do they have a track record of success? This is why careful selection is far more important than just getting excited about the potential upside. It's not a lottery ticket. It's an investment that requires homework. The biggest danger in this market isn't the price volatility itself. The real danger is poor risk management. Most people don't lose money in markets because their initial idea was wrong. They lose money because they get greedy. They don't have a plan to take profits, or they use too much leverage, or they put all their eggs in one basket. This recent crash didn't punish silver as an asset. It punished leverage. It punished overconfidence. It punished a lack of diversification. The modern financial system is built on speed and leverage. This makes it incredibly efficient when times are good and the seas are calm. But it also makes it extremely fragile during periods of stress. And every time that stress appears, we see the same cycle play out. First, there's forced selling as leveraged players get margin called. Then, liquidity retreats as everyone gets scared and holds onto their cash. This leads to a panic in the narrative, with headlines screaming about the end of the world. And then, for those who are prepared, opportunity arises from the chaos. The collapse in the price of silver isn't a sign that silver is a bad investment. On the contrary, it's a flashing red light that the entire system is under immense pressure. The same forces that caused this silver sell-off are building up elsewhere, inside the private credit market, within the banking system, and even in the global currency markets. We are heading towards a world where governments and central banks are trying to exert more and more control over money. At the same time, trust in those very institutions is getting weaker and weaker. Historically, that combination of centralized control and declining trust drives massive interest towards tangible assets like gold and silver. But it only happens after a period of intense volatility shakes most people out of the market first. So the path forward for silver will not be a smooth, straight lineup. Expect more volatility, expect sharp rallies followed by sharp pullbacks. Expect governments and central banks to respond with new policies, trying to calm things down. Expect a constant battle between fear and opportunity, played out in the headlines and on the charts every single day. What matters now is not reacting to those headlines, but understanding the underlying structure of what's happening. Silver didn't fall because of a sudden panic. The panic came after. It fell. The fall itself was caused by pressure building up inside a crowded leverage system that finally broke. Once you understand that, you stop being shocked by the volatility. You stop being scared. You start being prepared. Because in every financial crisis, the real winners aren't the ones who react the fastest. They aren't the ones glued to the news. The winners are the ones who take the time to understand what's actually happening beneath the surface. And right now, silver is telling a much, much bigger story than most people realize. Thanks for watching. If you found this valuable, please subscribe for more insights.